All right. This is episode 27. Welcome to Bearish podcast. Max and Logan cannot join me today, so it is just me. And we're going to have a quick little episode about our good friend Michael Burry. If you guys don't know who that is, he is the hedge fund manager for Scion Asset. Let me try that again. He is the head fund manager for Scion Asset Management. Most people know him from The Big Short, bet on the housing market going down. He was right, profited hundreds of millions of dollars for himself and his clients, and he has been on a tweeting rampage recently. He's a little weird on Twitter. He'll tweet something and then he'll delete it real quick, and who knows. But I follow him, and this is what he had to say. On June 15th, at the date of this recording, it is June 19th. This episode will come out probably a week or two from now. Michael Burry put around 2 or 3 tweets out, and this is what he said, the first one. People always ask me, what is going on in the markets? It is simple. Greatest speculative bubble of all time. In all things. Okay? Second, that's what he tweeted out second. All hype/speculation is doing is drawing in retail, me and you, before the mother of all crashes. FOMO, parabolas don't resolve sideways. When crypto falls from trillions or meme stocks fall from tens of billions, Main Street losses will approach the size of countries. History ain't changed. Now let's break this down. He said the word speculation, okay? Speculation is the purchase of an asset with the hope that it will become more valuable in the future. It's kind of like crypto, how I've been saying about crypto. No one really knows the value of it. All you do is you buy it and you hope someone else pays more than you did. You're hoping it goes up. That's what speculation is. You're hoping. You don't know for sure, you're hoping. And someone may ask, isn't all investing speculation? No, it's not. The difference between investing and speculation, aka gambling, investing is knowing the value of a stock or an asset like real estate and paying less for it than what it's worth. That's what investing is. Gambling is hoping you'll be right. You're speculating you will be right. You're speculating someone will pay more. You're hoping someone will pay more than you did so you make money. Investing is calculated. Gambling is not. And I don't want to hear that gambling is not, the over-under is this and the spread is this and this team scores this. No. You're hoping you're right. That's all it is. When you go to the casino, you pull down the slot machine, you're hoping that you hit. You're hoping you're going to make money. Okay? He also said the word FOMO. Said FOMO parabolas don't resolve sideways. FOMO is the fear of missing out. Everyone has experienced FOMO at one point or another. It's natural, okay? We're human beings. We don't like to miss out on things, okay? We like to follow each other. We like to follow the herd, and that's what you're seeing in the market right now. Your friend's telling you, bro, I made this much money, and I made $1,000 in GameStop. You gotta hop in. You're like, shit, I wish I made $1,000. So you hop in. You're scared you're gonna miss out on more gain, on more money. You're scared that your friends are gonna make more money than you. It's okay to be honest. It's okay to feel that way. It's okay. It's natural. Okay, so FOMO is the fear of missing out. It's a very natural feeling, but it's also very dangerous. You see it with GME. You saw it with Doge. You just saw it with AMC. You're seeing it with a lot of these meme stocks. It's natural. And hedge fund managers feel that with each other all the time. They're judged by their clients on a month-to-month basis. Okay, because if this fund isn't performing like the other funds, their clients will move their money to the other fund. So hedge funds are very, very short term. They always want to get an edge on their competition because they want to keep their clients. They want to keep that money in. Because at the end of the day, they don't make money without their clients' money. Simple. Okay? Michael Burry also went on to say this. The problem with crypto, as in most things, is the leverage. If you don't know how much leverage is in crypto, you don't know anything about crypto, no matter how much else you think you know. Okay? What is leverage? Leverage is simply borrowing money so you can buy more stocks. That's also known as margin or margin debt. It's the amount of money that individuals and institutions borrow against their stock holdings, aka money loaned to you by your broker. You use that money to buy more stocks, buy more whatever, options, whatever you want to buy more crypto, whatever you want to buy. Okay? Margin is at all-time highs in the stock market, and it is not even close. It is nearing $800 billion of margin in the stock market. The next highest was a little over $650 billion. That was in what year is that? 2018. That was in 2018. $650 billion, just a little bit over. We're 150 billion plus over that. Okay, according to FINRA, which is the Financial Industry Regulatory Authority, which is a government authorized organization that oversees U.S. brokers, and they work under the SEC. They pretty much make sure everything's going right in the markets. They don't want to see any fraud, any insider trading. They like to educate investors and so on and so forth. They're like they're just like the little brother of the SEC. They just, help out. And this data, the 800 billion, is just, that's all tracked by them. Okay. Now, what does leverage do? Like I said, leverage is borrowed money. People borrow that from their broker to buy more and more things, buy more and more stocks, crypto, whatever. Borrowed money pushes prices of things higher. Because once people run out of money to buy, to use, they go and borrow it, and then they buy more things. Okay? They buy more things, and what causes prices to go up? It's buying. Okay? Now, Michael Burry he's not wrong. I would say he's very right in saying these things. Most people don't want to agree with him. I'm not going to say most people don't agree. I'll say most people don't want to agree because on the inside, maybe they know he's right. And it's very hard to come, to terms with, shit, I may be in trouble here. Because what happens when you're leveraged or you're over leveraged, there's a margin maintenance requirement. According to FINRA, it's 25% of all of the margin you are using. If your stocks you're using margin on or crypto goes down, you either one, have to deposit more money, and I'm guessing you're not going to do that because that's why you're on margin anyways, because you're probably out of money or you don't want to use any more money of your own money. So either you deposit more money or you sell your stocks or your crypto so you meet the minimum maintenance requirement for margin. And that's what you saw with Bitcoin when Bitcoin crashed from freaking 60K to 28K in 3 days. That's what happened. People were over leveraged. They didn't wanna, or they didn't have money to put in. So they sold it. That's what you have to do. You have to put up collateral. All markets appear to be way over leveraged. Way too much borrowed money. Because at the end of the day, like we've talked about on this podcast numerous times, bonds don't give you any return on your money. In fact, you are losing money due to inflation. And we all know inflation is going to be a big problem in the future. It just will. Fed doesn't really know what it's going to go to. They said 2% this year, and then now they're saying 3.4%. They're not really sure what's going to happen. So when your only option to make money on your money is in stocks, because you're not putting your money into real estate. It's so expensive. It's way too expensive. Real estate is at all-time highs because of the lack of supply, not many homes, and the increase in demand. So you're not putting your money into real estate. You're not putting your money into bonds. You're going to put your money into stocks. You're going to put your money into crypto. You're going to put your money into anything. Okay? Anything, even if the stocks are too expensive or the crypto's too expensive. What's your other choice? What other options do you have? You're going to put your money into stocks. You're going to put your money into crypto. And if you run out of money, you'll borrow money. In fact, I know people that have maxed out their credit cards because their credit cards are charging 0% interest. So they will max those out and use that money that they borrow. They'll borrow money on their credit cards. They'll take that money and put it in the stocks. 0% interest. So their goal is to make money. I mean, it's free money. They're trying to make money on that money, you know? So that's what you're seeing in the market right now. Michael Burry is saying it's going to be the mother of all crashes. It's the greatest speculative bubble of all time. No one really knows what's going to happen. They just, FOMO, leverage. I mean, it's crazy. It's crazy. So to end this episode off, I have a little bit more time. I want to talk about the Buffett indicators. The Shiller PE, named after Robert Shiller, and the Wilshire GDP, not named, but after the Wilshire 5000 index. And Warren Buffett loves to use this, and he says in his own words, where's the quote? In his own words, Warren Buffett said that this, here we go, probably the best single measure of where valuations stand at any given moment. So let's go over the Shiller PE first. The Shiller PE is the average PE ratio in the market. The average historically is 15.83. Right now, it is at 36.95. The highest it's ever been was 44.19, and that was the dot-com bubble in 2000. It is way over what it was in 2020 before the market crashed. That looked like, I'm looking at it right now, it looks like it was around 33. Not way over, but, considerably. It's at 36.95, reaching or approaching 37. The highest it's ever been, like I said, was 44. We're getting up there. I'm not sure what's going to stop it. I'm not sure what the market's going to do. If I did, I'd be rich. I'm not sure where this Shiller PE is going. It looks like on this graph, it's going straight up. Okay? The Wilshire GDP, this right here, compares the stock market, all the U.S. stocks listed on the stock market, and there's about 3,500. The reason it's called the Wilshire 5000 index is because in 1974, when it became, a thing, there were 5,000 stocks in there. Now there's around 3,500. I may be off by a little bit, but it's around that. So it takes the market cap of all of those stocks and divides it by the gross domestic product of the United States. Okay, and then it times it by 100 to get a percentage. If it falls between 50% and 75%, the market can said to be undervalued. If it falls between 75% and 90%, it's fairly valued. If it's anywhere between 90% and 115%, it is modestly overvalued. Anything over 138%, it is significantly overvalued. Our current state, the current state of this market sits at 198%. Let's just call it 200. 200%. Anything over 138% is significantly overvalued, and we're sitting at 200%. Now, I'm not saying the market's going to crash or, watch out, sell your stocks, get out of the market. No, I'm not saying that because no one has any idea what the hell is going to happen. Okay? I'm just saying, historically, we are in uncharted waters, unprecedented territory. And I mean, a lot of the great investors are, issuing warning signs. Warren Buffett's sitting in over $150 billion of cash because, simply he can't find anywhere to put it. Everything's too expensive for him. Here we have Michael Burry tweeting like a madman about how crazy the market is, how speculative it is, how FOMO is driving it up, how leveraged it is. I mean, it is what it is. Take what you will from this, but you can't say he's wrong. That's what I'm going to end this on. You cannot say he's wrong, no matter how bullish you are, no matter how invested you are. You cannot disagree with Michael Burry. You cannot say there is no FOMO because there is. You cannot say there is no leverage because leverage is at all-time highs. You cannot say that the market's not speculative because, well, you'd just be wrong. You'd just be flat out wrong if you said that. Okay? I mean, it's that simple. I believe Michael Burry's right. I believe that the amount of, and it's in the numbers as well, the amount of retail traders and investors that have entered the market is astonishing. I mean, it's crazy. It's, it all started when the market crashed. We were locked in our homes because, the government and COVID and all that. The government said, you can't go outside or blah, blah, blah. People had, stimulus checks coming in, free money. And if they didn't need that for their bills, put it into stocks, put it into crypto, and that's what you see. You're just seeing people get more and more greedy, and that's what's driving the market up. Their gains isn't enough. So take that for what you will. That's the episode. This was a weird one because Max and Logan were here, but I did my best. I tried. So that is all. That is all that I have for you. If you want to connect with us and follow us, we have our Instagram, we have our TikTok, we have our YouTube, we have our YouTube Shorts, we have this Discord that it's kind of shit, but hopefully we'll get it, going in the future. And yeah, follow us on our socials, and we'll see you guys later. Peace.